G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. All right, let's go. So the topic for this video, we're going over some news regarding economic numbers coming out, and we're also talking about rate cuts, probabilities, Bitcoin conference, and effect on price it will have, and also some recession indicators that I believe will be proven right. And yeah, we'll see how soon the recession comes, but looks like it's very imminent, looking according to these indicators that I'll be showing you in this video. So let's start off with the numbers and economic data that's come out. So we had durable goods orders come out last night, my time, Australia. Durable goods month over month. So the consensus was 0.3%. Orders month to month from June. This is calculating June's data. And we got, previous was 0.1%. And look at that, minus 6.6. So big miss on that front there, which is quite nasty. And I'll just click into it to show you what we've sort of experienced from the start of this year. We had a negative 0.6, 0.9, and 0.7 February, March, 0.8, 0.2 in April, and then we sort of start to slow down again. So April, May, 0.1, and then we've had a big drop off in June. And you can see we do have big swings, like go back a year, 5 years, and we're on the decline. It's trending down. It's not looking quite good. We had the pandemic drop. Of course, we had a big decline there. And look at 10 years. We did a decline in 2014, pretty negative. But we're heading that way now. Looks pretty bad. And will this trend continue even lower? It looks like it's going to get worse as people slow down. Suppliers start to order less goods, and the inventory stacks up. They're trying to get rid of excess inventory. But it's the new orders for these manufactured goods are going down month over month, and over the years I just showed you, it's pretty negative. So we got that. We also got GDP growth rate quarter over quarter for Q2. The consensus was 2%. Right, previously was 1.4%, and we came in at 2.8%. All right, so better than expected. And it sort of shows you over time from 2022, we did have 2 negative quarters, which historically in the past, I'll show you a 10-year or even max, you can see every time it sort of had 2 negative quarters. We had a recession. 70s was a bad drop as well. We had a bad negative decline in 1980, 1981, recessions. A recession there. And there as well. 2008, we had negative quarters here. 2001, we didn't have back-to-back quarters, but we did have negative quarters. And 2020, of course, 2 negative quarters, and 2 negative quarters in 2022. So these are big drops in the stock market. And will we see it go negative? Because it's been going still holding up pretty strong, despite the state of the economy, the jobs market, the manufacturing sector. But the GDP numbers have to go negative to really show us that we're really slowing down. So that's something we have to watch going forward. And we do have tonight, the core PCE month over month and year over year numbers coming out. So we have consensus 0.1% and previously 0.1%. So to stay flat, and 2.6% is year over year PCE, and expected, I think, the same 2.6. So will we get a higher or lower reading? It really will tell the Fed, give it better indication of when rate cuts are going to come. but we have to wait and see. And I look at other data coming up as well. But this is coming up tonight, quite important, called PCE inflation. As you know, you go back to 2023, a year ago, and we are going down significantly, especially from the big uptick there, month over month numbers, 0.5% increase. We're getting slower increases here. So will we see negative numbers to give the Fed more leeway to cut rates? So that's that data. And we have the Fed CME watch tool here. And I'll just zoom in a bit better. As you can see, September. So before we go to September, we've got July, end of this month. The probabilities are 6.7%, so not very likely to cut. And then we have September, 2 months' time, middle of the month. We have an 88.6% chance, so cut there, and 11% chance of even bigger cut. Right, so we have practically 100% chance of rate cuts coming in September. Will that happen? We'll have to wait and see. And if that doesn't happen, then we have to wait another 2 months, November, and it's signaling there's a 39% chance or a 54% chance, respectively, depending on the size of the cuts. So we have to wait there, wait and see how that's going to play out. And we have the Bitcoin conference happening right now as we speak for a few days in Nashville. And we have, DJT speaking, Donald J. Trump, and RFK Jr. and Michael Saylor, Cathie Wood, and Russell Brand, Edward Snowden, all these people speaking. But all eyes are on Trump for this one. People think this will have a big impact on price and going higher. I don't think so. I think it has nothing to do with the price. It's just people want a narrative to tie to the price to be able to. If it does dump, they go, it's just because it dumps every time we have a conference. But that's not necessarily true. We do have periods, ups and downs during these conferences, but they say that it's because the hype is so, highly expected, and the price is expected to go up because there's some good, great speakers and optimism for the Bitcoin network going forward. It's necessarily, this is the narrative that people want to associate with the price of Bitcoin, which I don't think it's going to affect it much at all. I think it's going to go down after this event, really, because this is what the market makers and the big whales play games, the retail investors. And I think it's just to buy the rumor, sell the news. Especially, this can have a big impact going forward into next year. These things are lagging events; doesn't happen straight away. Doesn't affect price. And you go back to this is what really matters: the cuts, not the Fed, how they respond to incoming economic data. If it gets weaker and weaker and weaker, especially in the job numbers, this is what's going to affect the price the most, not the conference. Okay, and then we have JT, lest we forget, my thesis since 2022 correction, 2023 rally in all risk assets, 2024 a collapse of it all. So you can see this trend line going back to 1929, the very, very infamous depression, Great Depression there, 80-90% correction in the stock market, S&P, and 2000 was pretty negative. 2008 there, and now in 2024 we're sort of approaching this top of this trend line, the peaks where we have a big sell-off like 2000 or 929. There will be blood. We'll have to wait and see for that one. Capacity letter, wow. Ford stock F is having its worst daily performance in 2008 financial crisis, currently down 18%. Ford is set to post its biggest daily decline since November 19th, 2008. The biggest difference, Ford was on the brink of bankruptcy the last time its stock declined this much. How is this soft landing? I agree with them. Look at that. 18% in a day. That is horrible. Ford, one of the most robust automotive companies, especially American automotive companies. And it's, the worst since 2008. posting its weak earnings numbers that came out. I spoke to in the last video. This is terrible. Going back to the financial crisis, 2008. So, and automotive demand is slowing right down, especially for new vehicles. It's slowing right down. And this is a very interesting comparison, talking about, comparing this period, 2008, which is not very, very good, and it looks alarming signs. But, another factor you can consider when coming to a recession, coming to the end of the year or next year, it's only a matter of time, okay? And also, talk about the manufacturing sector, coming from cars to the manufacturing index. And the Richmond Fed manufacturing index dropped to 17 points, minus 17 points in July, the lowest level since the 2020 pandemic. The drop has been primarily driven by the new order volume and shipments slowing to 23 points negative and minus 21 respectively. Aside from the pandemic, this is the worst reading since the 2008 financial crisis. Oh God, another 2008 warning. Meanwhile, the nationwide manufacturing sector has experienced its second longest downturn on record, contracting in 19 of the last 20 months. Is the manufacturing industry signaling a recession? And we had the survey, the current manufacturing composite, and survey current manufacturing employment versus the manufacturing composite. And we're seeing a decline, like we did crossing the zero line. In 2020, we had a big drop. 2008 crisis, of course, big drops. It's happened during recessionary times, okay? And the biggest downturn, we've been contracting for 19 of the last 20 months, which is quite staggering. And another sign of recession. It's imminent. So be ready. Don't get too optimistic about all the headlines and all the bullish sentiment that's on Twitter. Get heaps of influencers coming out saying this is a bit buying opportunity and we're going to go higher from here. We've got the Bitcoin conference, it's bullish. No, this is this will affect the crypto market and the stock market. Most markets, and we'll have to wait and see whether the declines will be as bad as 2008, but we'll get the recession nevertheless. It's just inevitable. Another tweet by JT. A reliable leading indicator. It's preceded all prior recessions and stock market corrections. Temporary health services. When it accelerates, the economy is in growth mode and is in risk on. When it falls, the economy is in contraction and risk off. It's now collapsing. Source. The source there. And every time it's declined, temporary health services, the stock market in white, compared to health services, you can see, recession, 2008, and recession 2020, and we're getting a big decline from the 2021 peak coming into now, and it's steepening. It's falling off a cliff right now, and yes, that's not a good sign at all. Another economic warning, recession indicator is flashing. So, another one to stack up to build up a thesis of why a recession is coming. It's pretty negative. You have global markets investor, another US recession warning. The number of people receiving unemployment benefits spiked greater than 30% over the last 2 years, the highest increase since the COVID crisis. In the past, every time when the US continued jobless claims rose more than 20% from their lows, a recession followed. So jobless claims and the 2-year lows, and the change, 20%. We've crossed that level. So recession's imminent. You can see 2020, we obviously smashed right through it. 2008, 2000, 1991, 81, the mid-70s, early 70s. Okay, so they're all recessionary periods. and we've crossed it now. So only a matter of time before a recession hits, and reality is hitting mainstream media, and we get some fearful articles and stuff. That will happen around the bottom of this recession, not the top, not the start of the recession. It'll happen more or less into next year. We'll have to just wait to see exactly how bad it gets, but the more negative the reports come out, the more likely we're coming close to the end of the recession, not the start of the recession. Okay, so they won't call it until the end. The the analysts won't say, okay, we're in a recession yet, until the recession's ended. It happens always at the end. It's a delayed indicator, but we'll get ahead of this. When all these, especially the SARM rule, when that gets triggered, and it'll tell us, okay, the jobs market is taking off, accelerating, unemployment rate's going up, and jobless claims, it's already a signal we're in a recession. So, we have to wait and see that. And finally, we'll talk about a tweet from Guilherme Tavares. Yields will go down, and this time was not different. So the yield curve is another recession indicator, and a crash in yields, the 10-year yield. Every time we've crashed, we have recession, 2000, 2008, 2020, and now will we get a crash in yields and the yield curve inversion between the 10-year and the 2-year yield. When it crosses back down, if you flip it upside down, that's the chart that I usually show. We've been inverted for 2 years now, so we have to uninvert. When we uninvert, the recession precedes it, or goes after it, comes after an uninversion. So we have to wait and see there. That's definitely going to happen. It's another indicator that's showing that we are imminent for a recession. And don't think that all this bullish sentiment, the Bitcoin conference, and China unbanning Bitcoin at the end of the year is going to drive the price higher. Tools like this, rate cuts coming is not a positive sign; it's a bearish sign. And giving these negative numbers in the durable goods orders, to wait and see from the PCE numbers, but and GDP, see it slow down, and then really start to see recession kick in. So it's only a matter of time. They're my thoughts going over the economic data, durable goods orders, upcoming PCE. Talk about GDP numbers coming in better than expected. Also, the Bitcoin conference, how that won't really affect price. It will tie that narrative to the price, of course. But I've said in previous videos that price precedes narrative, not narrative precedes price. So that's something to shrug off. It's another catalyst that everyone will blame. If we do have a drop, it's a buy room and sell news sort of thing. And also just going over rate cut expectations and talking about recession indicators, like jobless claims, help services declining, and just looking at other indicators that really signal a recession is coming. It's inevitable. Just be in the watch out. It's something we have to prepare ourselves for going into the end of the year and going next year, not to get too optimistic. And we'll have to wait and see. It's one of those things where we're proven right once it happens, not before it happens. You're the hero after the fact. Not you'll be getting shamed when you're calling it before it happens, but you'll get praised once after it happens. So anyway, I'm not really an economist, predictor. I'm just showing you what I can see out there, and the indicators don't look promising. And make up your own mind about that one, but I'm just showing you the facts. All right, that being said, please smash the like, comment your thoughts below, subscribe to stay updated, and I'll catch you next one. Cheers.